All right. Hey, guys. Welcome back. Live at 5. My name is Jeb Smith. We have Josh Lewis with us, who many of you know. We've had a lot happen in the last couple of days with regards to real estate and mortgage. Josh wearing the same outfit as me, people bagging on. There's a lot to talk about here. We got Zillow. We've got the Fed meeting that happened today. So there's a lot out there. We've got questions coming in from you guys, which we will address. Josh, welcome to the show.
That is really, really disappointing that I was obviously up before you this morning and had my attire selected, and then you copied it. So it's a little creepy. I'm thinking maybe you were lurking outside my house to see what I was going to wear. And for those of you that are outside of California, just know that we are entering the cold, dark days of winter here in Southern California, and it was in the mid-60s. So we both needed a vest to stay warm today.
Absolutely. Yeah, it dropped below 70 and quite frightening, in fact. So we had to pull out the and the office,
the winter
honestly,
attire.
guys, the office is like 7 degrees. It is so cold in this place that if you don't wear some layer, it could be 80 degrees outside. You'll still freeze in here. So that's why we're wearing this. But aside from that, everyone's favorite, my mustache, it's still here, guys. What I've determined is that the women hate it. Like in the comments, who I think are women commenting, absolutely hate it. The guys are like, it's like a bro stash. They're like all for it. I'm with the ladies, kind of hating it here. So chances are tomorrow this thing's gone. But I wanted it to make a live appearance.
Who knew that Ned Flanders was not a chick magnet? I would have never guessed.
Well, I mean, it's the risk you take, not knowing.
I say
Here we
though,
are.
that's the poll we need to put up. It's 70% Ned Flanders, 30% Ted Lasso. So you're splitting the difference there, but leaning more Ned Flanders.
You know, I almost wore my full. I'm trying to get my mic situated here, guys. It doesn't sound right. Actually almost wore full Ted Lasso Halloween costume in here for the show, and I was just going to do one-liners the entire show just for fun. Anyway, guys, so we appreciate you being here. If you have questions, put them in the comments. We will get to them. So Josh, let's talk about Zillow, right? We've been talking about Zillow on and off for years without the recent news in the market, right? You've heard me talk. Viewers have heard me talk about them buying houses at prices that I thought were crazy. Not really sure why they were doing it, how they were doing it, why they were justifying it. And then recently, that guy came out and posted that TikTok video, and it made a lot of sense. And you started thinking, okay, that's probably what they're doing, right? They're buying one out of many at a higher value in order to justify the other ones, maybe pull the comps up a little bit, then they can sell those for higher. I think what it came down to more than anything else is they were just buying property and really had no idea the prices that they were paying in a lot of cases. And so here we are now, right? They're in a position where they're losing money. They don't have the workers to take on the property. They have 7,000 properties they can't deal with. They don't have the manpower to handle it. They're losing money monthly by holding onto this property. And now they're in a position where they have to sell it, right? So they're looking for one buyer to buy 7,000 properties. So the question for many is, what happens if these properties come to the market, right? That's a reasonable question. And do you think, Josh, I mean, we'll just ask you first and then I'll give my opinion. Do you think one buyer is going to buy these properties? How do you think this thing plays out here over the next couple of months, right? Because it's not going to happen tomorrow or the next day. It's going to take some time to unfold.
You have to see the portfolio. Like you and I know they were buying here in Southern California, and we've talked before. What do institutional buyers want? They want bread and butter, single families, middle America that they can pick up for $250,000 to $325,000 and generate $1,500 to $2,000 a month rent. They're going after yield with that. But we know that Zillow is buying everywhere. So if you have a $700,000 or an $800,000 house here in Southern California, an institutional buyer doesn't want that. Institutional buyers probably don't want condos. They don't want to get involved with paying HOA dues, any limitations that might be placed upon them from the association. So it's really going to come down to what that portfolio looks like. They will be able to find buyers for large chunks of it, and they're big enough and not so far underwater on most of them that they'll just sell them off one by one. So what's the total count? Do you remember the total count of units they have that they want to sell?
I think it's 7,000.
Okay, so seven, and think about that. To us, we're like, wow, that's spectacular for one entity to own 7,000 units. In the grand scheme of things, what are we going to have 800,000 resale units this year? It's less than 1% of the market, even if they all sold immediately at a moment's notice, which it won't. Some of it will get absorbed by institutional buyers, and some of it will have to go out one by one. So there will be some additional. There will be some additional inventory there. And more importantly, what do we talk about? We always say with a foreclosure or a short sale, the reason why those would ever sell at a discount is if there are multiple homes on the market, the person that's most motivated to sell is a bank that just wants out of it. So to a degree, Zillow's in that same situation. They've announced they want out. They're not saying, hey, we're busted or we don't have money or we can't carry these properties. They surely can, but they would be a motivated seller in the market. One of the reports I was looking at today is talking about how we're still at like an average of 25-day market time, which is a hot seller's market. It could move the needle a tiny bit the other direction, especially in any specific market where they were overexposed. But I don't know that they were buying enough to really impact any micro market where we're always talking, that real estate's local. We talk about these big macro trends nationwide, but really you need to know what's happening in the community you're interested in buying. And they don't own any in any one community that would really lend towards moving the market. And if someone has information that they do, I'd love to see it. Maybe they were buying that heavily in other parts of the country.
Yeah, I mean, I definitely think they were focused on a couple of markets, right? I mean, the Phoenix market, they seem to have a big hand in that market, right? The metro area of Phoenix, not just Phoenix itself. You're talking about Scottsdale, Glendale, that whole metro area. So if you're in one of those markets, that could help out inventory considerably, right? I mean, I earlier this week I talked on video about a report that I received from an agent friend in that market that does a lot of business, and it's the Cromford report for anybody out there that's in that market familiar with it. And he said that they finally reached, inventory's been increasing. They finally reached 1 month of supply of homes, and you're like, wow, 1 month supply, wow, congratulations. I mean, that is minuscule in the big picture, but for them, he said he can't remember the last time they had a month, right? So it is ticking up, which is huge. But if you've got one of these companies that has a lot of properties there, that could help the inventory in that area, right? I mean, one thing to understand here is that the Zillows, the open doors, the investor buying, regardless of who it is, individuals, corporations, whatever, they still make up a very small percentage of the market. You're talking about 20% of active sales a month are investor purchases. We're not talking 80-90% here. So, taking one person out of the game doesn't necessarily change the game. It affects the game, but it doesn't mean the game is completely changed, right? If everybody said we're stepping aside, then that's a whole different equation. But let's talk about this, because this is something that everybody's saying at the moment, Josh, is that they have the data, right? So they have the data on everything at the moment, right? I mean, just based on the number of people looking at Zillow, searching from Zillow, people entering their personal information or whatever, and that they have some foresight and that they see that the market is changing, and therefore that's the reason they're looking to sell all these properties. What are your thoughts on that?
Do you, or do I, or does anyone else really believe that they have better data than other competitors in this space?
I think
They
some
are
people do.
they are the 10,000-pound gorilla there in terms of they have the biggest, but Redfin's buying. Redfin's still buying. They have very similar data. I think they have slightly less traffic. So it comes down to how you slice it and dice it. Is it possible? It's certainly possible, but to imply that the web traffic and search data is giving them insights, what are we talking about? It's high frequency data that comes in daily versus you having to wait each month for the reports that we talk about, existing home sales, new home sales.
Right.
Weekly we get mortgage applications. Well, mortgage applications weekly is pretty frequent. Well, you could say they're looking hour by hour, minute by minute. Is that additional frequency giving them insights? It could. Data is amazing, and then how you analyze that data is spectacular. And if Redfin was making the same decision, then I would be more inclined to think there's something there. And I just don't think they would be so far ahead of it with the data that no one else would be picking up the same sort of smoke signals. But it's going to be interesting. Everyone has an opinion on what next year looks like. Most of the people that I trust are coalescing sort of around the same ideas. Even those that have a little bit of disagreement it's more of the longer term perspective. It's not so much on what happens in 2022, it's what's 2025 and further down the line. And that's really, really hard to forecast that far out. We've all sat here. We had a recession last year for 6 weeks, 8 weeks, the way they actually defined it and measure it, but it was COVID related. It wasn't something that the economy turned and went negative. It was we shut the economy down and had a forced recession. So what I was saying with that is we had like 11 straight years of economic expansion, but it was really weak expansion. That's somewhat how this housing expansion has gone. In 2010 was where we finally kind of put in a bottom, and we've been increasing ever since then. But prior to COVID, it wasn't these exorbitant, massive numbers. So it would be interesting what happens, because if you look at the long-term trend, we had 10 years of increasing home prices, or 9.5 until we get into COVID. And we were just right below the long-term trend for home prices in most areas. So we think often of California, Southern California, and you look at the long-term trend line, we were still below that. And now with a year and a half of monster price spikes, we are above trend. So everything, every number, every piece of data that there is mean reverting. So if you get too far below it after a big crash like 2008, it's going to get back to that trend line. When we get above the trend line, we know we're going to mean revert back down to trend. And there's a couple of ways that can happen. It doesn't have to crash or crater. You can be flat for an extended period of time. If you look that the trend is for things to go up in price, if we get above that trend, you can just stay flat for a long time. So those are the questions that we're looking at. We're not going to see a crash in housing. It's just, we've gone through it before. We have record levels of equity. We have record strength in terms of the mortgages that have been put on the books over the last 10, 12 years. We're not going to see a crash. And anyone that says they're talking out their ass, literally talking out their ass, because there is no crash coming. That doesn't mean we can't have a 20% correction. A 20% correction is not a crash. If you remember, right at the beginning of COVID, the stock market dropped over 20%. No one's saying, oh my God, it's a stock market crash. There actually probably were people on YouTube calling it a crash, but that's a correction. It's a correction, and it just depends on how long it happens. So it's going to be at some point in the future, and largely the issue or the problem, anyone that's cursing high home prices has no one to blame but our government that has borrowed so much money that they have to keep rates low. They can tell you it was COVID. They can tell you it was the financial crisis in 2008, but they've borrowed so much money and are paying out so much more than they take in taxes that there's no option but to keep rates low. When rates stay low, the value of assets, whether it's stocks or houses, remain elevated. So historically, yeah, home prices are high, but there's nothing that's going to change because the government needs interest rates to stay low and to go even lower.
Right. And let's not just spend the whole show talking about Zillow, right? It's supply demand. We've talked about this. Will Zillow's exiting the market have an impact on the market? Sure. It absolutely will. Is it going to crash the market? Absolutely not. It's going to have less demand, right? Less demand for those properties, those investment properties that, the iBuying, if you will. Less going crazy on some of these properties and bidding way above the asking price by a corporation. Doesn't mean that typical regular home buyers aren't going to do the same thing in some of these markets. And supply, right? Supply. We talk about it. 7,000 homes. If every single property they had hit the market, it's a blip. It's not even 1%. The number is very low. I mean, it's a lot of homes, right? But they're not going to all hit the market at one time. There's a chance, like Josh said, that several buyers, corporations, hedge funds, different parties pick up different pieces of that puzzle. Some go to the market, some don't, all that good stuff. In some markets, it's going to increase inventory, but inventory or supply and demand, right, drives the market. You guys hear me every week. Today in Orange County, 1,770 homes. I looked it up just a minute ago while Josh was talking. That's the lowest number of homes I've seen in Orange County ever. I don't remember a time when there's been less active homes on the market since I've been actually following that number actively, right? Even in the spring of this year when the market was hot, we had more than 1,770 homes on the market. We're 3.3 million people here in Southern California. Huntington Beach, we're at 118 homes. And when I say homes, I'm not just talking single family detached properties. I'm talking condos, townhomes, any senior living, properties on leased land, all of that good stuff. That's what the numbers are. So very, very low numbers, guys. And until that changes, you are not going to see a change in the housing market. I don't care what company falls, what happens anywhere. It supply, demand. Simple. Very, very simple. The equation always equals the same thing. It doesn't change. But that takes us into interest rates, right? Interest rates are one of those things that could impact the market. Interest rates rising impacts demand. Impacting demand increases potential supply. Supply rising, right? Less demand means a more balanced market. The longer that inventory builds, that means it becomes closer to a buyer's market. You reach a certain period, it becomes balanced, so on and so forth. At no point there did I say crash, right? More balanced. But the Fed came out today and Josh, more or less went along with what we thought was going to happen. They said that they were going to start tapering. What does that mean? What happened today with bond prices? Where do you see things going?
So people have been worried about the tapering. Well, what happens when the Fed stops buying? So what they've been doing is they've been buying both treasuries and mortgage-backed securities. I believe the number is 10 billion a week in treasuries and 5 in I turned the lights out in mortgage-backed securities. And what they're going to do is start peeling away a little bit at the number. Actually, that's the amount they're reducing each month. So I forget exactly what they were buying, but they've been buying fairly aggressively in the market. So new buying. So what they're not doing with the tapering is stopping their reinvestment. So when someone sells their house, the mortgage pays off. When someone refinances, the mortgage pays off. They're taking that money and they're going right back in and buying mortgage bonds. Also, we talk about supply and demand in terms of supply of mortgage-backed securities and treasuries. So the government is borrowing less than they were at the peak of COVID to finance all of the aggressive spending they were doing. So there's less issuance, there's less supply, and now there's going to be less demand. So probably already priced in. And on the mortgage side, as mortgage rates are a little bit up from the super all-time lows, there's less supply of new mortgages coming to the market. So they're buying less, but there's less supply. So I think it's a little bit overblown to worry that that this taper is going to do anything negative. We've seen historically, other than the first time they did the tapering of the first QE, they did it a little clunky and didn't really announce it. Came to market quick with it, and we had what was called the taper tantrum, where bond yields shot up. We've seen since then that tapering actually leads to some improvement in bond yield, so lower bond yield. So I actually expect the market to improve, but we say that cautiously. I wouldn't make bets on it. You know, if you're saying something 60-40 or 55-45, you're not going to run down to the window in Vegas and lay a bet down. You're going to go, I'm pretty sure this is going to happen, but it could easily go the other way. So we want to watch it closely. The technical sort of set up to see some more improvement, but that doesn't mean, you know, if we're just a hair over 3% right now, it doesn't mean they're going back to 275 or 2625 like they were at the best levels. Just means that I think we're likely to hang out here at these levels for a while, and I don't worry about what the tapering comes down to. If anything, the Fed is still really accommodative. I sat and had CNBC up over here in the corner, just listening to what everyone was saying, and the press conference and the questions that Powell was getting today. And everyone is pretty convinced that they're still way too stimulative. So someone had asked the question, well, just say hypothetically, the Fed wakes up tomorrow and they announce they're raising rates 1%. If they raised rates 1%, that would be a shock and it would throw markets for a curve. But if they did that, that would still be really stimulative, accommodative, dovish policy from them. We would still, with currently, we do believe that the inflation is temporarily elevated, but if we're at 3 or 4% inflation and you have Fed yields at 1%, you're still having a negative real rate of return. So that's very stimulative. So if anything, I think the Fed is on the wrong side of it. They need to be raising rates for the long-term good. People think that means, hey, if the Fed raises, that it's going to shoot rates higher. It just means no. They're taking away the punch bowl before things get too hot, which we are seeing. I mean, stocks are at all-time highs. Home prices are at all-time highs, and that's solely, wouldn't say solely, that's largely because interest rates are so low that there's nowhere else to put money.
No, agreed. And you know, we'll kind of wrap this part of it up by just saying, you know, each situation is a little bit different, right? It's likely to be a bumpy road ahead, and bumpy road in the sense that you're going to get data mixed signals. You're going to get mixed signals for the next couple of months because, you know, again, we're comparing numbers year over year, right? To last year, last November, last December was not typical of that time of year, right? And normally October, November, December, the last quarter of the year is typically a slower quarter because the seasonality in the market. Last year was different. 2020 wasn't a normal year by any means. And when it comes to housing, it definitely wasn't normal because you missed the first quarter of the year. And a lot of the smart people that I read, that talk about housing in last year, they just basically say, hey, look, you missed you missed that first quarter, but it pushed everything a quarter forward. So, you know, that the spring market, which is typically the first quarter, became the second quarter, second became the third, and that summer market, which is typically, you know, the summer fall, became the fourth quarter, which is still an active time in the market. And that was last year. So where I was going with this is you're going to get mixed signals. You're going to get signals that say, hey, listen, year over year, things are declining considerably from where they were last year. This year is more normal this time of year than last year was, right? So you're comparing year over year, numbers are going to be way down. But that doesn't necessarily mean there's a huge shift in the market. But regardless, you have to do what's right for you, right? I mean, if buying now is in the cards, pay attention to what's important to you and stop, getting caught up in, whether or not the market's going up or down by 5% or 10% or whatever. Josh and I talk all the time. As long as you have a longer term horizon, it really doesn't matter. It doesn't. You shouldn't be so concerned with, the direction of things if you have that horizon. I mean, that longer term time horizon, because at the end of the day, you're going to win. I mean, that's what it boils down to. So,
and Jeb,
anyway.
think about this. That long-term time horizon is really important for an entry point for a first-time buyer. If you are a homeowner now and you're thinking of selling and buying, most people are moving up. So if the market is appreciating, you're better off getting out of a lower priced asset into a higher priced asset so that it appreciates more, and doing that sooner rather than later. If you're downsizing, you have to kind of look into that. But really, timing the market is irrelevant for move-up buyers. If you're moving from one piece of real estate to another, maybe you want to consider the two different markets and how they're performing over time, but everything's been hot here recently. But for a first-time buyer, an entry point is important. You want to make sure you're not entering somewhere that's at a near-term peak where you might be trapped there for a period of time. But I don't think that we're anywhere near that. And I wanted to piggyback, Jeb, you said something that was really important. Year over year numbers for the last year have been really cloudy, hazy in terms of trying to draw conclusions with them, because last year was really weird. March, April, May were super low. And then starting in about July, they got really hot all the way through the end of the year. Start of this year was really hot, looking back to kind of a normal or a much lower period. So the year over year stuff for January, February, March of this year looked crazy. Started to kind of normalize when we had a hot July this year and a hot July last year. They kind of look the same. But most analysts are going back and comparing and saying, let's look at 2019. 2019 was a good market, but not a crazy hot market. So people are saying, yeah, see, you're starting to see cracks. The market's slowing down. We're going to see home prices drop. We're going to see a crash. Well, if you look in terms of October 18th to 24th, 2019 to 21, purchase mortgage volume was up 54%. Up 54% from a good market. 2019 was a good market. It wasn't nuts. Home prices.
It was a solid housing market.
A nice market. It was almost Goldilocks. Buyers liked it because it wasn't going crazy. Sellers liked it because they were getting good prices. But we're up 54% in purchase volume 2 weeks ago, and everyone's saying, "Ooh, the market's cooling." Well, just be careful the way you define cooling. It is absolutely cooling. It's cooling from absurd to something less absurd, and we're all hoping that it cools to something normal. Like, honestly, my biggest worry or concern is that we get double-digit increases again next year. That will be problematic for us in 2023. So hopefully it slows down and we see 4, 5, 6% home price increases next year. I don't think we're going to get it. I think it's really going to be in that 10 to 12% range, and you start hitting affordability walls for entry buyers. And all of you guys here, individuals are already hitting affordability walls. I mean, as a group, the collective of first-time buyers starts hitting affordability walls if we see another 10, 12% appreciation in the next 12 months.
No, I understood. I'm with you. Let's see here. So,
Alex Radoni had the comment of the night. He hit the nail on the head. It's Ned Lasso.
Classic.
It's not Flanders or Ted Lasso. It's Ned Lasso.
Classic. Let's see here, just to make sure. Okay, so let's get to some questions or some comments here. So Michael, one of our regular viewers here, last week he mentioned that the builder had said that he couldn't build on the lot that he was buying because a variance was needed by the city. Comes out today to say basically he called the city, and the city stated that a variance was never requested by the builders at a red flag. Seems like one. I would try to find out more information from the builder, find out exactly what's going on, see if you missed anything, why they're stating a variance was needed. Again, most developers, when they're building communities, have to get these variances. At least here in California, you're supposed to do that prior to building, right? There is a plan, some sort of development plan that gets approved by the city prior to starting a project. You don't go into a project and then start picking out how you're going to define a lot. I mean, a lot of that stuff is done prior to that project ever getting moved to begin with. So to me, it seems odd that they're coming back now saying they can't build on a certain lot that was probably, in my opinion, approved by the city to start. So something definitely to consider from your side, but it's hard to say one way or the other because Texas is Texas.
Texas is Texas. It's the Republic of Texas. But the thing that I'm coming back to is they're going to get caught eventually because there's no world in which they're going to leave that lot unbuilt. They're not going to just go, hey, let's just put that, we'll have some grass in the neighborhood over there. It's going to get built on eventually. From everything you've told us, it definitely sounds fishy, and I would love to know what their end game is. So if you've talked to the city and the variance was never requested, just call them on it. Say, yeah, I'm not a construction foreman. I'm not a builder, but can you help me understand how a variance that was never requested could be denied and would make me not be able to get my lot?
Exactly. Yeah. Just have that conversation. I mean, I think maybe get something in writing from them, and something you can talk to with the city. At the end of the day, that contract, as we've said many, many times with the builder, very much favors the builder. So, there's a lot of language in there, a lot of lingo that's probably difficult to understand and, hard to make sense of. So, maybe you get an attorney involved, if it gets down to it. All right. So let's see. BB, current homeowner in OC looking to downsize and retire. Use my equity to pay cash in a retirement community in San Diego. Will need cash. Bridge loan. Do you underwrite bridge loan? So let's talk about a bridge loan, Josh. What is a bridge loan for those who don't know? If you're going to use the equity from your property to buy something else, if you're planning on selling, having the cash and doing it, you don't really need a bridge loan, right? But if you've got the equity in your property right now, you want to buy that other property prior to selling your property, that's where the bridge loan would essentially come into play. But Josh, bridge loans, underwriting, how does it work?
It's where a lender uses the equity in your current property to either fund the purchase. So they're basically going to lend to you secured by your current property to acquire the new property or to be the down payment for your purchase on the new property, just depending on how much equity you have. I mean, just no idea what the situation is here, but let's say she owns a property free and clear. She or he owns a property free and clear that's worth $1 million. They're downsizing to a property that's 500,000. You would get a loan from a lender against the current property for the 500,000. Close your new purchase, knowing that the home is going to be sold and they get their money back. So realizing that most loans done today are low or no cost in terms of points and fees. And that's because the lender can count on owning the loan for a period of time and making money on the interest. These loans, everyone knows they're going to pay off fairly quickly. So you will pay some fees for them. So they do exist. There's definitely options there. And we could definitely do that for you. So if you're already here in Orange County, give us a call. Whether we have one of the best options or we could point you in another direction, there's definitely options out there for you that would work.
Yeah. And then if you get to the point where, you don't have enough equity to put down on that next property, but you've got a decent down payment, hard money could be an option to bridge that gap. I mean, there are definitely options for you when you have that equity. So yeah, reach out to Josh. We'll put some contact information up here at the end. If not, there is a link in the description below you can click on to get a referral, and I'll get you connected. So that works. Let's see here. So Tracy says her brother was a renovation superintendent for Zillow 90 days ago. He got notified today he's getting laid off along with 2,000 others across the country. So, they laid off 25% of their workforce. Not sure what departments, but my guess is it all has to do with that iBuying. Probably the people that were in charge of the prices that they offered on some of those properties, right? I always laugh when people are like, Zillow's going to take over your job, for years. And I'm like, oh, well, look how that played out, huh? You actually need somebody to look and determine the price of a home, and the computer isn't necessarily the best option to do that.
And think about it, Redfin's done the best job of coming up with a different model, but they didn't really change the game. They just said, let's make an assembly line of like 6 people that will touch and do all the things that one realtor does. So I like to tell people, when you look at any of these big disruptors, what have they really disrupted? We've seen 2 or 3 major Silicon Valley startup mortgage companies come and go. The best example I love to use that's still around is Better.com. They love to tell you that, hey, we don't use commission salespeople, so we're going to save you money. They do have really good rates. They also operate at a loss, a large loss. If you look at their public filings, you see that they lose money on every loan that they do. And every person that I've ever talked to that's spoken with them, we do probably a loan or 2 a month for someone that started down that path and realized there was no world in which they were actually going to get an offer accepted working with a 9-to-5 uncommissioned person sitting in a cubicle. So there's lots of disruption, and everyone looks at real estate and mortgage from the outside and goes, I can fix this. They don't realize how much regulation we have. I don't want to say most, it probably is most. The majority of the difficulty and headaches and hassles that people complain about in the mortgage side of it are things that are necessitated by government regulation. Some of them that are valid and should be there. Some of them is just silly government bullshit. And people from the outside look and they go, that's a pretty simple process. I can reverse engineer that, put some technology in place. We can decrease the cost. We can do it faster. We can do it better. And then they get in and they go, oh, wait, there's reasons why my lender did those things that way when I bought my home last year. And it was so awful. And I got this brilliant idea that I was going to reinvent their industry.
No, absolutely. That's, yeah, it's you know, these companies often think there's a better way, a cheaper way, and sometimes there is. But you know, when you're dealing with emotions and a lot of other factors, it's very hard to price what's that worth in the end game. And when you're talking numbers, financial numbers, and helping people understand them and explain them, that's a whole different deal. I mean, you're talking people's largest financial transaction probably ever. That there needs to be some hand holding in there, and the inexperience doesn't, you know, it shows. It bleeds through when you have that person on the other side of a transaction, whether it's real estate and or mortgage. So, but Coinster, another regular viewer, commenter on videos. Appreciate you being here. Is there anything on the horizon suggesting that spring 2022 will be unlike spring 2021? So let's take a minute here and talk about spring 2021. Probably the fastest moving housing market that I've been associated with since I've been in the business, right? Things were selling above the asking price, people waiving contingencies, multiple offers, appreciation, you know, just going crazy. You know, from what I'm reading, what you know, a lot of the economists are suggesting is that there are actually going to be less transactions in 2022 than there are in 2021. So the number of home sales is actually going to go down, but it's not going down by a lot. It's a small number, but you know, the things that could impact it. Let's talk it. Affordability for one, right? Affordability last year, spring is probably what? 10% lower than the prices we're at now, maybe even a little bit more than that. So affordability is going to play a part in that. Interest rates are also going to play a part, right? We don't know where interest rates are going to be. While we don't think they're necessarily going to be higher, you know, them moving 0.25% from, you know, in the spring, where were we on interest rates, Josh? 2.5, 2.75 or so.
Well, remember, I mean, we had that little spike in March and April. So take out March and April, we were below 3% January, February, and then by, you know, late April, May, we were back under 3% again.
Yeah. So, I mean, there's definitely an opportunity to impact the housing market some. The real question comes down, again, supply demand, right? What does supply look like that? I do know there are people sitting on the sidelines with the thought that they're going to put their homes on the market come spring. I know several of them. Some of them are potential listings I'm getting. Some of them are friends that are in the business that actually own property that are, you know, going to list their own home. So there is going to be some inventory coming to the market in the spring. The question is it enough to slow this whole thing down? And I think I do believe that there's going to be enough inventory to kind of not necessarily balance the market, but not to have the same issue that we had last year, which was just no supply, right? We started the year, there wasn't a lot of supply, and it just never increased. It just never picked up. And I guess I'm saying it wrong because we have inventory. It's not that there's not inventory. It's just that the demand is accelerating so fast that the inventory can't stay on the market. So there are properties coming. It's just being met with demand. But I think as as prices continue to rise, you're getting people priced out of the market. I mean, I've got people reaching out to me saying, Jeb, I want to buy a house in Orange County for $750,000. I'm like, a single family? Yeah. It's damn near impossible. And it seems crazy. Like, it's crazy to me. Like, when I think Orange County and all of these cities out there, you can't find a decent single family home for under 750,000. It's like shocking. It really is. I mean, there are some out there, don't get me wrong, but there should be way more than the number that there is. And it's difficult. So I don't know. Josh, thoughts on 2022 spring? I think it's going to be hot. I do think things are going to move. Is it going to move as fast as 2021? I have a hard time believing that we could duplicate that. But
what the last thing you said, I don't see any way that it could potentially be replicated because, again, what were the causes? Rates were really low, and you had all of the people that wanted to buy in 2020 that didn't got pushed into the first part of the year. Because remember, one of the reasons why the fourth quarter is so slow is kids get back to school. People do like to buy before and be moved before their kids go to school. But once we hit Thanksgiving, so like for us, I've got about 2-3 weeks of normal volume, even though it's tailed off some since summer. Once we hit Thanksgiving, the phone calls, they don't dry up, but they definitely slow down between, say, Thanksgiving and all the way into about the second week of January is our slowest time of the year. So that didn't change last year. The people that didn't get to buy in 2020, they still had that seasonality of, you know what, it's hard to deal with buying a house between Thanksgiving, Christmas, New Year's. So they get out the first part of the year. And that's exactly what we saw. Everyone that would have bought in the second, third, fourth quarter of 2020 got squeezed into the first quarter of 2021, and they were all fighting over the same houses. We're not going to see that. That big pent-up demand, there's still a lot of demand, but that big extra wave of demand is gone. Rates are likely to be a little bit higher than they were last year. Home prices are starting from a 20% higher starting point. So you do have that impact of affordability, what a monthly payment looks like, even if you wanted to get into a bidding war and push it as high as people were last spring. It's just not there. So the numbers tell you it can't happen. And just flash back, I remember Jeb and I in March and April would have these conversations in the morning, like, what are we going to do? What are we going to do? I got a stack of this many approved buyers. And what are they going to do? They're going to keep beating their head against the wall and bidding against 50 people on every property. And we made it through, and it did finally normalize into what we're calling normal right now, which still is a strong seller's market and not a lot of fun for buyers. We always, when someone gets a property under contract, we congratulate them, but it's like, it's 10 times more sincere right now. You're like, hey, you won the war. You ran the gauntlet. You got one under contract. So we still have a ways to go until they actually close. But long way of saying there's no world in which next spring looks like last spring. That doesn't mean that the world's coming to an end or we have a correction or a crash coming. It just means we're normalizing.
No, and with that said, I mean, as somebody, again, that sees the market daily, I'm in it, around it, talking about it, I'm still shocked at how many offers some of these properties get, how far above the asking price some of these things go. I put in, one offer I didn't put in because I had a conversation with the agent, and at that point there was no point in putting in an offer. But over the weekend, two offers put in for two different buyers, both multiple offers. One, the property was listed at $950. This was in Seal Beach, in College Park West. For anybody out there that cares, $950 single level home. Client wanted to put in an offer. I told him, hey, it's probably going to sell for $1.05 million, right? Based on the last comparable that sold, it's going to sell $100,000 over that asking price. Just looking at that data, didn't want to go that high. Put in an offer in the high nines. We didn't get a counter back. It ended up selling with multiple offers. I don't know what price it ended up going at, but I have to assume it was somewhere close to the number that I mentioned there. But another property here in Huntington Beach listed at $949, sides to a school. So for the average homeowner, not a great location. My client was an investor, so cared less about that location because it would rent. It would rent really well because it's a good school district. The location for somebody that their kids would go to school there, would be a great deal. That property was listed at $949. We were willing to offer $1,050,000, so $100,000 over the asking price. There were 20 offers at the time that I talked to the agent about our offer, and she said, we're not even in the game. And so, I mean, that was one situation. And then I have another buyer. So these are multiple different buyers. This isn't the same buyer. Another one in Huntington, cash buyer, property listed at $1,300,000, I believe. My client's a cash buyer up to $1,500,000. I called. They had 4 offers on that property, and basically said that at that time they weren't even accepting any other offers because the seller was ready to make a decision. So, even in the environment where things are slowing down, they're not stopping. That's what a lot of people don't understand. I mean, I had somebody message me this morning on Instagram and saying, "Hey, look, I want to buy in Orange County. I need an aggressive agent. I'm looking to put in offers 5 to 10% below the asking price." And I'm like, I'm not your guy. Like,
That's not an
I
aggressive
don't
agent.
know.
That's a glutton for punishment.
Yeah. Like, who's going to do that? I mean, who wants to do that? Because you're not a serious buyer if you're coming to the table like that. But anyway, things slowing down doesn't necessarily mean things have changed. It means slower than it was a couple of months ago. What are you comparing that slower to? It's all relative, right? It's always relative, but just understand where those numbers are being compared to. So,
hey,
yep.
Jeb, there's a good one here. It's funny. It says S. Bradley, so it makes me think of Sean Bradley. Remember the guy in the NBA that was 7'6"
Oh, yeah.
and super long and skinny?
Yeah.
So when I was in, I hope it's him. When I was in 8th grade, we had a basketball tournament in Las Vegas, and we were at Circus playing the little games. And Sean Bradley is sitting next to me, and he was like 7'1" in 8th grade with really long arms. So, the little thing where you put the softballs in the milk carton in the little milk jug?
Oh, yeah.
He's basically reaching out and dropping them in, and walks out with like 9,000 stuffed animals. Stuck with me my entire life. I thought that was pretty cool when I was in 8th grade, that he could steal all the stuffed animals from Circus. But the question here, let's just break this down. Lord, I hope it has a big correction soon, but I think it'll be 5 years of a slow decline back to that trend line. So a couple things. Hope is what we hear a lot. People, when you have the question, even the people say, I think, or I believe it's going to, they say, well, it has to. There's not a lot of data or thought behind it other than I really need it to get the property that I want where I want. So there's a lot of hope in that. What I will say, and I want to actually pull this up here real quick. Jeb, let's share this little tab over here. Oh boy, I got the wrong tab, Jeb. It's this little chart right here, but this is California home prices. California is much more cyclical than the United States. This was at the early 80s, and you had a little dip and it flattened out. This is to the early 90s, little dip. It was about a 10%. And then this chart stopped right before the big monster dip. So what you have to think in terms of is we're really looking at a 10% correction is kind of what a normal correction looks like, which is a big number. If we're looking at $850,000 median homes right now, a 10% correction would be $85,000. That's a lot. But anyone thinking that an $850,000 home is going to go back to $600,000 or $500,000, it's not going to happen. And when we talk about the government has to keep rates really low, we have people with a lot of equity, and we have really strong mortgage underwriting of those loans, you're much more likely, even than seeing a 10% correction, of seeing a long-term flat market, no growth. Maybe you drop 1% a year for a few years. Maybe you go up 1% a year for a few years and get back to that trend. That could be the new normal at some point in the future, but that's way further down the line once the supply and demand issues get worked out, which will be 3 to 5 years. We've talked about millennials, big wave of demographics coming into home buying age, and we have a 4 million unit housing shortage in the United States that can't be resolved in 2 or 3 or 4 years.
Hold on a second. So those 7,000 homes that Zillow has isn't going to solve the $4 million short. I mean, the 4 million housing shortage?
No, it won't make much of a difference.
But that math doesn't make sense, Josh. 7,000 equals 4 million short homes.
Yeah.
I've seen it. I watch YouTube. I know this.
Yeah. Yeah, no, and that's what people talk about. Like again, I don't care. People come on here and say, "Oh, it's a real estate guy and a mortgage guy." They're going to tell you these great things. Hey, you know what I do? You want to know where all of my money is? Other than my wife's 401k, nothing is in stocks. It's all in real estate. I have to make educated decisions for my family because that's where all of our wealth is. There's no reason for me to sit here and cheerlead or try to talk people into buying when it may or may not be a good idea for them. We know that long term, if you could pick an average entry point into the market where there wasn't high or low, homes weren't a great deal or they weren't overpriced, an average entry point, everyone should buy a home. It's just when is the right time in your life that
Right?
you're
No,
you're
for sure.
stable enough, your family, all of that fun stuff. And really for us, probably 35% of our buyers are first time buyers. So that is a big
Yeah.
portion of who we're dealing with. But for move up buyers, they don't care. If you've already had a bunch of appreciation and you need an extra bedroom and bathroom, you're going to buy the house and it's going to be $150,000, $200,000 gap. You're still going to buy it. I don't need to cheerlead the market. And I also don't need to show up here and scare the shit out of people with numbers that are manipulated. Like you showed me a video the other week from one of these clowns with a crash channel that it's just crash porn and he's manipulating numbers. He's blatantly and obviously manipulating numbers. Numbers don't lie, but you do have to analyze them and present them right.
No, absolutely. So we're going to move along here, get off the subject of crashes and all that good stuff and try to help some people. So right now it's a seller's market with 1 month supply. Balanced market is 6 months supply. How many months supply is considered a buyer's market? So the latest the latest report from National Association of Realtors on the existing home sales report, which comes out about the 20th or so of the month, said that there were 2.4 months on average for nationwide, right? Some markets, right? Phoenix market is up to 1 month supply. Here in Orange County, where we are, we're probably about a month and a half supply of homes. So depending on where you are, right? Real estate's local, you might have 2-3 months of supply, depending on what's happening in your market. But with that said, to answer the question, a balanced market, 6 months is when the sellers don't necessarily have an advantage, buyers don't necessarily have an advantage. And keep in mind, it's not 6 months on the dot, right? It's on average, this is how they dictate a buyer or seller's market. They also use days on market, right? When the average days on market, Josh mentioned a moment ago, the average days on market is about 25 days or so right now. I actually think it's a little bit less, but let's say 25 days. They say when the average days on market gets to around 90 days, it becomes a buyer's market, right? That's the way that they've defined those markets. In this case, balance market 6 months, anything over 6 months, right? 7 months would be at that point a buyer's market in that case. So, we haven't had that situation in a very long time. I mean, it's probably been 2011, 2010 since we were on the other side of that. Where we had that balanced market a minute ago. You heard me say 1,770 homes here in Orange County. I remember when the average number of homes on the market was 6,000, 7,000 homes. And even then, it wasn't a strong buyer's market. So we've got a long way to travel before that happens. But understand that those aren't fast, hard, numbers. It's just somewhere around that month of inventory is where you start to see the mind shift or the mentality of buyers and sellers change a little bit, and the buyers have that advantage. So.
And to put that in context, in 2009, nationwide, the average time on market got to 12 months. So,
Okay. Yeah.
so like that's double where it gets to the buyer's market. So the time we remember, like I was buying homes late 2008, 2009, 2010. We could name our price. Banks had no buyers. So they could say, we can continue to own this home longer, or we can take whatever the offer is. That's what the insane bottom of the market looked like, where you had a year supply of homes on the market and a buyer could literally go, I want to be in this neighborhood, what homes are available, and I'll go make a reasonable offer, or I can go and say, who will take my lowest offer, who is so tired of owning that asset. And they weren't individual buyers or individual owners, they were banks. So who wanted that asset off their books the most? That's what a crazy buyer's market looks like.
No, agreed. Al, what's up, fellas? Al saying, how do grant deeds work when selling, and when do you sign them in the sales process? So a grant deed is essentially the title of the property, right? Who owns that property? It's it's part of the process. It's a document that you sign when you purchase a property, and when you sell a property, you're essentially selling the grant deed and granting that property to the new owners. And it's a document that has to be notarized. It's one of the few documents here in California as a seller that actually needs to be notarized as part of the transaction. The question is, when do you sign it? Really, I mean, whenever you want during the process, but you don't want it to hold up things at the end of the transaction. So typically escrow gets open, you'll get an escrow package from escrow within the first 7 days or so. That documentation, there's some information you have to fill out in there, statement of information, all this good stuff. One of those documents, grant deed, needs to be notarized. And I have, occasionally buyer or sellers reach out to me and say, well, what if I get this notarized and the buyer that we're in escrow falls out of escrow? Is this document still good? Yes, that document is still good. It doesn't need to be re-notarized. Escrow, a lot of times when they get that document notarized, the name on there is in a place where it could be changed if they need to put in a new buyer or what have you, if something does happen. But the earlier in the process it gets done, the less of worry that you have to deal with at the end of the transaction with regards to paperwork and things missing and what have you. I've had deals get held up at the end because for whatever reason, the escrow didn't have the signed grant deed back. In fact, one of them was in Australia. The client that owned the property was in Australia, and getting something notarized in Australia during COVID, this was during COVID, was an absolute nightmare. And it delayed the process about 6 weeks because of how the whole process worked. He had to go somewhere and get it notarized. I forget now because it's been, about a year or so since that happened, but I had to get it notarized, and then to ship it, FedEx it took like 2 weeks from Australia during COVID for that document to get here. So it's best to get it done early in the process.
So Jeb, oftentimes what people freak out about, they're like, no, that deed is giving that other person my property. They don't want to sign it until the very last instant. But part of your escrow instructions is the instruction to escrow. Yes, you are signing it and you are giving it to that neutral third party, and they are only allowed and instructed to record it, affecting the actual change of ownership if all of the other conditions of that escrow are met. And if they don't, they have to destroy it, give it back to you, whatever the case be. So they only get to record it and actually affect the change in ownership of the property when you get to closing, regardless of whether you sign it on the first day of escrow or the last.
Good point. I was actually in my head when I started that little dialogue there, and by the time I got to the end of it, it was long gone, and I had gone I was in Australia at that time, bro. I was basking in Australia somewhere. I had an accent. I was fighting a kangaroo. It was a really weird situation. But anyway, if you're still here, if you're still here, you are here. If you're watching this, do us a favor, hit the like button. It helps us, helps the algorithm, helps people see it. We spend every Wednesday 2 hours that we could be spending with our families, but we're here helping you guys hopefully navigate this crazy housing market. So that's the only thing we ask of you guys, and we do appreciate the love and support.
For those of you new here, it is Wing Wednesday every Wednesday when we do live at 5. So we're putting off wings and beer at least 2 hours to answer questions.
I mean, you nailed it. Freddie Mercury, we got some Freddie Mercury comments here with the mustache. We had Ned Flanders. We had some stalker comments. I mean, there's a lot going on here in the, and I tried to do a survey on my channel about the mustache, and somehow YouTube wouldn't let it happen. I did the survey and it didn't get posted. So I thought, well, that was weird. Didn't go on there. So I did it again and it didn't post again. So I thought, wow, they must not want that survey to go out. So what happens, guys, the mustache stays. Let's see. Josh, do you underwrite bridge loans?
We don't underwrite anything. We are a broker. We find lenders that best fit your scenario, and they underwrite the loan. So it's our responsibility to know the guidelines that they're going to underwrite to. So yes, we have sources for bridge loans.
All right, we've got Mo Theory coming in with talking to Michael DeRee from earlier, saying getting a variance can be expensive and can be denied anyway. You need a lawyer, architect, planner, and contractor. So a lot going on there, Michael, if you're considering doing that. Let's see. Cedric saying, tried to get my PMI knocked off without having to refi. The bank denied, although they said my value did go up by over 120,000 since I closed in June of 2020. Is it too soon? I have to wait 2 years? ? So, Josh, this is a question you addressed last week. Typically, the lender wants to see a certain period of time of you making payments before they'll consider that refinance, or not even the refinance, the knocking off of PMI. What's the end game here?
They can require a 12-month or 24-month payment history before allowing it. So you're getting close. We're 6-7 months away. The values are not going to go down. So it sucks. I mean, if it's 100, 150, $200, another 6 months going to cost you about $1,200, but you will be able to get it removed. It's just going to take a little while.
There you go. I mean, your other option is to refinance it if you wanted to go through that process. Just be careful what you pay, because if the bank's going to end up doing it anyway, like Josh said, you're paying $1,200, or whatever that month difference. The monthly difference is. Just take that into account and see.
You just want to lay it out in a side-by-side comparison of saying, what's a new loan at a slightly higher interest rate with no mortgage insurance? And then what is my current loan with no mortgage insurance, but 6 months down the line, how much have you paid out? So it's a pretty easy calculation. Your lender that helped you with the loan should be able to walk you through that.
No, absolutely. John here, the mustache would make a good broom. Oh boy, would it? Yes, it would.
There's lots of jokes I could make there. I'm going to leave it alone.
So
it's a family-friendly show.
And this is a comment I want to address, because I often see people commenting and saying, like, I deleted comments. I've never deleted a comment on YouTube anytime ever. Doesn't matter if it's good, bad, about me, whatever. I don't care, guys. That's one thing you have to understand. You could say anything. You're not going to offend me. But here's the thing. YouTube actually does have a spam filter, right? So certain things that pop up in there is a whole different spam side that you have to go to answer questions or make them back, and understand, based on the number of videos that I have out there. I think I have like 600 videos somewhere on YouTube, like floating around that whole deal. People comment on all these things. It's so difficult for me to go back and start going through the spam comments, because a lot of them are garbage, and to weed out the ones that aren't and put them back in and all of that, it's just too much time. So if it ends up in spam, it's gone, because Jeb doesn't have the time, I'm like Zillow, bro. I don't have the manpower to deal with this, and I might just lay myself off here very soon if it continues. So
I was going to suggest that maybe Nightbot was sweet on you and was taking care of the anti-mustache comments.
No, man. I tried to post my own mustache comment, and it wouldn't. YouTube wouldn't even let me do it. So if other people are doing it, I get it. But yeah, I don't delete comments, guys. So you can trash talk me. You can do all that good stuff. It'll show up. And if it doesn't show up, Jeb didn't delete it. So anyway,
Jeb,
yep.
Let's go through that one, and then God dang it, I went and pushed the button. Go back.
You're good. All right,
here. Let's just take care of yours.
Hey, if you're in the underwriting process and you get a 1099, what would the underwriter do? Would tax transcript work? Josh.
Way more detail needed. What do you mean if you get a 1099? A 1099 got issued to you while you were in escrow, or your income is 1099. If you receive a 1099, there's no withholdings there. You're an independent contractor. We're paid as an independent contractor. That should go to a tax return. If you're incorporated or an LLC, you're going to have a business return, and that's just part of your income. If you are a sole proprietor and you're just reporting everything on a Schedule C, that income goes to the Schedule C. I don't care about the 1099. I care about the tax return that the data goes to. In certain situations, you can need the 1099, but for the most part, we're going to look at the underlying tax return where that 1099 income gets reported along with all of your expenses, so that we're able to calculate your net income for qualifying purposes.
Good stuff. Cedric, I just saw how many times you posted your comment. Bro, calm down over there. Jesus. You went wild there. I'm surprised Jennifer didn't delete you. Jeez Louise here. Anyway, you have a question there that you wanted to answer.
BookTube got us, and I'm still amazed by BookTube. I got to figure out what BookTube is. Sold in July, was waiting to purchase in January or February to see what my tax situation is like. So here's the thing. Nothing in tax law has changed since July. There is absolutely no need to wait until January. get with a tax professional, give them all of your information, and they can tell you right now within a reasonable number what that looks like. Realistically, from July to January, we're looking at 10% additional appreciation. So if you're buying a $600,000 house, it costs $60,000 waiting to see what the tax situation is. So most people are very lightly taxed on gains from a sale from the home because you have a $250,000 exclusion as an individual, $500,000 as a married person, and you're talking about your actual basis in the property. So any capital improvements that you've made since purchasing the home go on top of that. This is why you need to talk to a tax professional. I know it pretty well, but I don't know it like a CPA does. And I have these conversations with Kevin, my CPA, and say, hey, here's where we're at. This is what we're doing. This is what next year is going to look like. How bad of a bill do I need to be prepared for? So just long way of saying, don't wait to get answers that a qualified professional can get you now. So find a good CPA, get those answers, and buy. Now, if there's another reason why you just, hey, I did not want to buy till next year, but please don't wait because we're going to file taxes next year to see. There's nothing that's changing in the tax law or in tax forms that's going to change anything where you wouldn't be able to get a very reasonable estimate now of what your tax situation looks like.
Bro, your wife just texted me and said, do we plan our outfits?
Ha! Ha! She thinks she's got jokes. She's not. Nightbot's going to ban her if she's going to send bad messages.
Bro, that was a text. She didn't even come
Oh.
through the thing. It was like outside. She knew that we would ban her at that point. SCN 600. Any help on HELOC? Used forbearance to refurb home. Have a VA. Equity is 600 to 700,000. Being told I get loan for 6 months because I did forbearance. Credit scores of the 700.
Can't get the loan for 6 months.
For 6 months because of forbearance. So, Josh, thoughts on home equity line behind a VA first, coming out of forbearance? I mean, everything I've read is 3 months of on-time payments. I don't know if
it's going to be up to the lender, because forget about VA. They're wanting to get a HELOC. So the HELOC behind that is going to be up to the HELOC lender. And those are all portfolio loans. There's not any institutional secondary market really for those loans. So anyone making them, whether it's a bank or a private mortgage bank, they're making their own guidelines. So the advice would be, make some calls, call a few different places, see what their guidelines are. And then I guess the easy button that I would say, and there's probably a reason why you're not doing this, VA cash out guidelines are really loose, and you can go to 100% cash out. So you don't need to use the HELOC. The reason why you may be wanting to avoid that is if you don't have a service-related disability and you're not exempt from the VA funding fee, the funding fee on the cash out subsequent use can be fairly hefty. So if you are exempt, I wouldn't even ever think about a HELOC. I would just go and do the cash out VA.
Nah, and you people are killing me with these questions coming in more than one time. Like, I'm going down here and I'm reading the same thing like 10 times. I'm just going to chalk that up to YouTube not knowing what to do and just keeps posting comments. Wow. Holy cow, people. Let's go to a question here. Cindy, supplemental tax bill. Do I pay that, or do I contact the mortgage company to pay through my escrow account? Josh, how do supplemental taxes work? And what are supplemental taxes while we're talking about it?
So for anyone in 49 states not named California, you don't have to worry about this fun stuff. So in California, we have Prop 13. Prop 13 says when you buy your home, your property taxes can never go up more than 2% a year. So what happens over 5, 10, 15 years of ownership, your home is appreciating at 4%, 5%, 7% a year, but your taxes only go up 2%. So now you go to sell. You bought your home for $400,000. The new buyer is paying $800,000. The reassessment does not occur immediately at closing. So the new buyer, whose taxes should be based off of an $800,000 assessed value, is paying taxes on your $400,000 assessed value. So when it gets reassessed, they come back and issue a supplemental bill for the taxes on that $400,000 under assessment. We actually just had a call 2 days ago from a listener to the show that we closed in July. Their tax bill showed up and they had two fun questions. They sent a picture of their tax bill and a picture of their supplemental tax bill. They have their taxes insurance impounded, and on the tax bill it says real big across there, information purposes only. And the message varies by county, but I get these calls and texts and emails all the time. Do I have to pay this? No, it's there. It literally says for information purposes only. They want you to know what your tax bill looks like, what the assessment is for this year. The second piece, the supplemental tax bill, it's going to be between you and the servicer. Most servicers, if they know what in the hell they're doing, will allow you to send in the supplemental tax bill and pay it for you. The borrowers that we talked to yesterday, they called their servicer and said, nope, that's your responsibility. Now, here's why that was crazy. In their situation, when we closed, we set up the impound, collecting $780 a month for their taxes. Their regular tax bill was saying for 6 months that they were going to pay $3,500 or just less than $600. So the servicer, who they've been putting $780 a month into their account, is going to pay out $600 a month here at the end of the month, meaning they have that extra $180 that should cover the supplemental, and they're saying we won't pay it. So for them, it was $1,250 now, $1,250 in the spring. It's not a problem. They can pay it. And what we explained is at the end of the 12 months, where every 12 months your servicer has to do a reconciliation of your escrow account and say, hey, we have too much or too little in there, they're going to end up getting a refund of most of that money back. So talk to your servicer, ask them to pay it. Explain to them if they don't understand what we just went through, maybe show them this video. But most of the time, I would say more often than not, they will allow you to send in the supplemental and pay it for you.
There you go. I'm getting a lot of questions about Zillow coming in here later in the show. We addressed that at the beginning of the show. So maybe after the stream's over, if you're still on, want to pay attention now, just go back and watch the first 5-10 minutes of it. We do address it in more detail there. So just something to keep in mind if you're waiting for that to come back up. I think most people been here a little bit, don't want to hear us talk about it again. So just check that out. Keith is coming in. Is an 8% fixed rate 15-year HELOC garbage? They don't do appraisals. So if you have an 8% anything at this point, it's garbage. But 8% fixed rate, Josh.
So you left a lot of details out. So let's say you have a 500 credit score and they're loaning you 100% of your home's value. 8% would be a fantastic interest rate. So there are lenders that will go all the way up to 95, some claiming 100, but up to 95% of your home's value. The higher loan to value you're going to, the higher that's going to be. The lower your credit score, the lower it's going to be. And any combination of that is going to work through. Not doing appraisals, not a big deal. I mean, for the most part, AVMs are close to as good as an appraisal in this day and age, and they're just saying, hey, at 8%, we'll take our chances. So without knowing a little bit more on that, you can't say it's terrible. What I will say is you're going to pay a higher interest rate for a fixed second. You can get a HELOC in the 6% range, and you're going to pay more than that for a fixed second.
All right, there you go. I messed up. 8% still garbage. Anyway, just my thought, man.
It's all relative.
It's just garbage, bro. Rick says, when you sell a property as a single person, do you not pay stepped up basis on $250,000 of equity? So when you sell a property and it's your primary residence, you've lived in it 2 of the last 5 years as your primary residence, you get up to $250,000 tax-free, exempt, part of the capital gains exemption, right? $500,000 as a married couple, in addition to any other improvements you've made to the property, so on and so forth. So, but the basis, that $250,000 is tax-free capital gains. I'm assuming that's what you're asking in that question.
Yeah, because it's throwing him off a little bit, saying stepped up basis. Stepped up basis is an entirely different thing. If someone passes away and you inherit the property from them, let's say your great grandpa paid $50,000 for a house 50 years ago, and he dies and leaves it to you, and it's worth $1 million now. Your basis is the $1 million it was worth on the day that your grandfather passed. That's a stepped up basis. Your basis is stepped up to the value on the day that he dies, different from your capital gains exclusion as a single or a married individual.
There you go. Melissa, is there a max amount that can be given if a parent wants to offer a gift towards a down payment? No, right? Josh?
I love this question. There's 2 pieces to it. You're 100% correct. No, they can pay cash for the property for you. They can pay 90% down and you get 10% financing. Back in the day, Fannie and Freddie used to have a minimum borrower contribution. FHA would allow it to be 100% gift. Fannie and Freddie would not. Now all agencies are aligned. You can get it all gift, a portion of your funds. The second piece of it, a lot of times we have gift donors who don't understand tax law, and they say, hey, I'm willing to give you a gift, but I can only give you, I forget what the number is now. Is it $15,000 per individual per year?
Or yeah, something like that.
So that is 100% true, and that doesn't affect your lifetime exemption. So your lifetime cap of gifts. If they give you more than that, you're okay. They need to report it to the IRS and say they made a gift exceeding the annual limits, and that comes off of the lifetime exclusion for gifts, the lifetime gift cap. So just don't get hung up on someone not being able to give you a gift, or that you're going to get taxed on it, or they're going to get taxed on it. Not at all. It just comes off of your estate maximum gifts for a lifetime.
Right. Good stuff. Let's see here. So BB comes in and says, unless you're over 55 in California, you can take your original tax basis to replacement property if equal or less than original property. It's actually not. It's if you are over 55, you can take your original tax basis to a replacement property if equal or less. But you now have Prop 19. Again, it only applies if you're 55 and over, and you can actually go up in value as well. And you only pay the higher taxes on the difference in that value. So if you sold a property for $500,000 and you're buying one for $700,000, you keep the tax basis on that $500,000 that you had with your original property, and you pay the stepped up basis between that $500,000 and $700,000. I say 700 or 750. Either way, whatever that difference is, you pay, today's tax rate based on that. So it's a little bit different than what you're saying there. It's not. Unless you're over 55, you can. It's if you're over 55. So did I read that right? If you're over 55, unless you're over 55, you can take. No, if you're over. Anybody under doesn't have that option. Yes, that's correct. Just making sure I read the question correctly. I did see a follow-up here. So Cedric said, to follow up to his previous question, if I wait until June 2020 to have the property reevaluated and they do drop off my PMI, will my taxes instantly go up? No. But
and Jeb, I'm assuming he's in California, because everywhere else they're like, why would anything make my taxes go up other than the passage of time?
Right.
So California, there are certain events that are reassessable. A sale makes it reassessable. Making capital improvements to the property. You add a pool, you add a bonus room, things of that sort that actually add value to the property. Getting an appraisal, what your home is worth today is irrelevant to what it can be assessed for. It's assessed at your purchase price, and it can go up a maximum of 2% per year. So if homes are going up 4% a year in perpetuity, you're going to get annual 2% increases in your property taxes. You having an appraisal is not going to have any impact on what your assessed value is for taxes.
There we go. Let's see. Don Draper. Can you talk about how property taxes impact monthly mortgage payments? I'm looking at Texas. I'm seeing many people complaining about property taxes on assessed value. Thank you. So, I mean, kind of a vague question, or not unclear question in how your property taxes impact your monthly payments. They don't necessarily impact your monthly mortgage payment unless you impound your taxes, at which, and then you're just, it's based on the assessable taxes in that market. Doesn't really have to do with Texas. I mean, it could be any state for that matter. But Josh, what do you want to say about that?
Here, let's talk about a mutual friend of ours, and I don't know why I'm losing the name. You remember Colin? Colin. Soccer guy that you did the loans for?
Yeah.
In another lifetime, Jeb used to do loans. After he stopped doing loans, he referred me to a client named Colin. He was down in San Diego, had a beautiful bitchin' house in San Diego that he actually bought from Stifler. He literally bought from Stifler. It was a great story.
Yeah, I remember that.
So he got an awesome job offer in Houston. So he goes, you are not going to believe this. My $750,000 house in San Diego is nice. This $750,000 house in Houston is absurd. And he sends it over. It's a 5,000 square foot house, bitchin' pool, just amazing house. And we start working on doing the loan for him. I'm looking at him like, Colin, your tax rate is 2.9%. So his taxes in San Diego were 1.1, 1.2. So it was 2.5 times as expensive on the taxes. And that was before his homeowner's insurance quote came in. He was paying $70 a month for his homeowner's insurance down in San Diego, and it was like $350 a month in Houston because of the hurricane risk. So for Californians who are fleeing to Texas, there's two things they need to be super aware of: what they're giving up, which is low property taxes, and what they're getting. So you're going to pay really high property taxes, really high homeowners insurance, and what you're getting away from is a state income tax. So while you're working, a month or so ago, we talked about this on the show. One of my buddies is in Dallas. Went to his place. He has a bitchin' condo. I was like, this is rad. And then he tells me his property taxes, I just about choke. And then we start comparing state tax bills, and he's like, I'm like 20, 25, $30,000 to the good versus you paying your low property taxes and state tax bill versus me paying these high property taxes. I said, cool. Someday I'm going to retire and have a much lower taxable income, and I'm still going to have, because of Prop 13, my low property taxes. You're going to have to figure out how, when this $700,000 condo is $1 million condo, how to pay $25,000 a year of property taxes while you're retired. So it's just something to consider when looking at other areas where you can buy nicer homes at lower price points.
No, good stuff. Got a good question here from Grace. Grace says, would it affect our closing if my husband deposits a good amount of money in his bank account? We are both on the loan. Just wanted to double check. So my understanding, Josh, unless they're using those funds to actually close on the property, it doesn't really matter. But if they are using those funds, that they probably have to source them. So what's the goods on that?
If you're not using them for closing, they can back them out and act like they never saw it. If you have to use them for closing, every agency, FHA, conventional, so Fannie, Freddie, they look at it slightly differently in terms of what constitutes a large deposit. So for the most part, FHA is 1% of the purchase price. Conventional is 50% of your monthly income. Anything above that is going to be considered a large deposit and have to be sourced if you're going to use those funds for closing. So the most important part, Graciel, is to just make sure you're working with a good lender who can explain and answer these questions for you.
There you go. Let's see. We have a good question here. Javon's asking, what should I be doing now to be pre-approved in 6 months from now? Josh, if I were looking to buy 6 months from now, what would your advice be?
Let's use this as a teaser. Jeb and I are working on this through the rest of the year of putting a program together, because one of the best things you can do is start preparing 6 months ahead of time. So we're going to be working on putting basically a first-time homebuyer challenge together that will walk you through this. But 6 months ahead of time, what do you want to be doing? You probably, this is a crazy thought, want to talk to a lender. I get questions all the time. It's too early. I don't want to waste your time. Is never too early, because we can give you the framework of what you want to be doing. But you want to be maximizing your credit score. So if that means paying some debt down, possibly opening up some new accounts and using them if you don't have a lot of depth of credit. So with 6 months lead time, you can affect some large changes in your credit score and improve the terms that you're going to get and the options available to you. You want to look at, where are price points at? Where do I need to be? So how much money do I need? If I'm buying a $450,000 house, cool, my down payment at 5% is X, but how much do I need for closing costs that time of year? What am I looking at? What am I expecting the payment to be? The benefit of going through it with a lender up front is that you know that you don't have unrealistic expectations. If you're looking around in certain areas and you know homes are X dollars, you need to find out, do you qualify for that, or are you open to other areas? So it really is never too early to start the pre-qualification and then get an action plan. But really, just making sure you have enough money to close, maximizing your credit score, not moving money around. A lot of times people will have funds. We just talked to Graciel about a large deposit possibly coming in. If you have that, it's not a problem after 2 monthly statements that don't show the deposit. So lots of things in planning that you can do ahead of time, but get your money in the right place, get your income optimized if there's a potential of working some additional overtime between now and then. So lots of things you can do, but it really starts with consulting on a pre-qualification, a pre-approval, and figuring out where you need to be.
All right. So Nikki Sav has some questions, a couple that have come in. Some of them were the same, some of them were different. So I want to go back here and answer a couple of them. I'm not ignoring you, just trying to get some questions going here. So for one, so seller of property. So it looks like selling a property, buyers holding up escrow timeline because inspection contingency. What is the best strategy to get the buyer to conform to the escrow timeline? So we use something called a notice to perform, which basically says, hey, listen, in the California residential purchase agreement, there is an area in that agreement that basically says if if either the seller or the buyer aren't performing, you can send out this additional disclosure. And then the buyer or the seller has to perform and do whatever you're requesting, as long as it abides by the contract within a certain time period. The way the contract's written is it's 48 hours, right? You have 48 hours once you send that out for the buyer or the seller to perform. Can go to either side depending on who's not performing. Sometimes the seller is not doing what they're supposed to do, and the buyer is saying, hey, listen, I'm giving you this, and if you don't perform, even if I've released my contingencies, if you don't perform, I can back out of this transaction. So in this case, it sounds like the buyer isn't doing this, and I can speak to this firsthand because I just dealt with this yesterday. And we'll go over that one here in a minute, but you have to send a notice to perform. You have to send something out and draw a line in the sand. But if you do that, here's the caveat. Is the line in the sand real or is it imaginary? Are you just throwing this out there, threatening with the idea that, even if they don't do it, you're not going to do anything? Or are you being serious saying, hey, if you don't perform, I'm backing out? And so outside of that, there's nothing you can do. I mean, you can play the game and wait and whatever, but the reality is an inspection contingency. I mean, what time frame was allotted in the contract initially? I mean, that should be one of the easiest things to actually perform because you have control over it. All you have to do is get an inspection. Things like appraisal, things like loan, those can be held up by a third party. As a buyer, the one thing that you can actually control is when your inspection happens. For the most part, maybe the inspector's delayed or whatever, we'll get another one. You have a contract to abide by. So that's how I would deal with that. But true story, as of yesterday, here, property locally, client is buying an up-leg property. So she's selling her property, up-leg property she's purchasing. We're in escrow on that up-leg property. Loans approved. Appraisal is completed. Inspections done. We're ready to go on the up-leg. We're just waiting for the buyer to perform on their side. Well, last week, we had to send a notice to perform because some stuff happened in the contract. They tried to go from a conventional loan to a VA loan without us telling, blah, blah, blah. We sent them a notice to perform and said, hey, listen, you have to release all your contingencies except for the loan because the loan wasn't due yet. We couldn't ask them for the loan release and said, hey, if you don't, we're going to back out of the contract. As the seller, we need to confirm that you're moving forward. And they sent back the notice to perform. I mean, they signed it and said, hey, we're releasing contingencies. We're good to go. And they still had the loan contingency out there. Well, as of last Friday, I believe the loan was supposed to be removed. We sent them a notice to perform on Wednesday of last week saying, hey, listen, you've got until Friday to release contingencies. If we don't get it back by 5 o'clock at Friday, we're backing out. We need to confirm that you're moving forward. Well, if you've been in this business long enough, you know that a lot of people are out there bullshitting you and, don't give you straight answers, so on and so forth. So I was kind of reading that that's what was happening. Wasn't real clear on what was going on. I spoke to my client. She said, hey, let's give them basically through the weekend, see what happens on Monday. As of Monday, nothing, still weren't getting released. So we sent basically a cancellation. I said, hey, listen, if we don't have, full release by 1 o'clock on all your contingencies, we're backing out of this transaction. Line in the sand, whatever. Sent the cancellation to my client. She signed it, sent it over to the other side. Took them a while for them to get back to us, but they basically ended up sending it back to us signed. So we canceled the transaction on yesterday because essentially what it came down to was the buyer couldn't get a loan. And they were trying to figure out a way to make it happen. And we could have continued to play that roundabout and let things play out or whatever. But the caveat here is that, my client, again, had that up-leg property. The longer we draw out the escrow that we're in, even if they could have performed, what happens if they don't? And then the seller on the property that she's buying isn't willing to work with us. So open communication. I call the agent on the other side and say, hey, listen, this is what's happened on her property. She still wants to purchase yours. we've got buyers that are willing to move forward on her property, but our timelines are going to be a little bit off. I just want to be transparent. This is where we're at. We're doing everything we can. It was cool. She called seller. Seller said, we'll work with you. We put her property back into escrow today because that's the market we're in, right? Where things are moving fast, and things moved on. But we weren't able to get there because with hand holding, we had to be firm and send out cancellations and do things that you don't want to have to do, right? You don't want to put your client who's already in escrow on an up leg in a tough position, but that's what we had to do in this transaction in order to move things forward. And having somebody on your side that has the experience and can guide you through that process is important, right? My client didn't want to send that cancellation. She was hoping that the buyer side was going to get things done. And I finally asked her, I said, it's like she's a school teacher. I said, it's like talking to your kid and telling them, that empty threat. Hey, listen, if you don't do this then we're leaving. It's like taking your kid. You're at the park and they're doing something wrong. Hey, if you don't start listening, we're going to leave. They do it again. If you don't start listening, we're going to leave. Eventually they know you're not going to leave. Just like, if I keep telling the seller, hey, or the buyer, we're going to cancel. If you don't give it to me, if I don't provide them with a document that says, hey, listen, we're going to cancel. If you don't give me what I need and actually follow through, then they're controlling the situation. And as a seller, you can't have that. So long story. Sorry, went off on a tangent, but hopefully it provides a little bit of clarity there for you.
She had a quick follow-up and a different question, but I'm assuming it's the same transaction. Hopefully the story isn't as long on this one. How would I go about getting a full warranty deed with title insurance? What are the steps to do that?
A full warranty deed. What the hell is a full warranty deed?
So a warranty deed, depending on where you're at, in California, we're most commonly using a grant deed. A grant deed with title insurance obviates the need for a warranty deed. A warranty deed, if you don't know the other party, it provides a bunch of additional detail, and it's them warranting to you that I actually own this property. So people hear about a quitclaim deed. A quitclaim deed says, if I have any interest in this property, I'm giving it to you. So we're sitting in this office, I could quitclaim deed this property over to Jeb. Wouldn't do him a lot of good because I don't own this property. So a warranty deed gives you all the details, says who I am, I own this property, and I'm giving it to you. Title insurance.
Why don't I just get a prelim?
A grant deed with title insurance does the same thing. So you can talk to your title insurance company. They may be willing to do the warranty deed for you, but in essence, a grant deed with title insurance, they're doing all of the legwork that goes above and beyond what any verbiage in the warranty deed is going to protect you from. So really not necessary.
All right, there you go. Sorry, I couldn't help you there. Josh knew what he was talking about. My LLC income is bad. I have assets plus potential of retirement and or Social Security of age. Haven't dipped in yet. Great credit score. Can my assets work to be loan eligible? What else helps? Josh.
Yes, the answer is yes. So we can take a combination of the retirement and Social Security income and then annuitize the assets. Depending on the assets, different calculations are involved. So sometimes people are surprised at how much assets it takes to qualify, because when they annuitize that, they're basically just adding it to your income. They're taking this lump sum, putting it into cash flow, and adding that to your income, and then calculating a debt to income ratio. There also are loans that will simply look at, you have more than enough money to pay off the loan. We'll use that as your ability to repay the loan. So you're buying a $400,000 property, or you're buying a home and getting a loan for $400,000, and you have $1 million in the bank. They say, well, you've proven your ability to repay in that you can write a check for it. So there are some different options of what we can do. You could look at combining the retirement Social Security income with a bank statement loan, depending on the type of LLC you have and what you're doing. So you really need to talk to an expert that understands non-QM loans that can use alternative income sources.
All right. Tahan, I believe, has a question similar to the one that I took 10 minutes to address a minute ago. So what happens if the seller refuses to perform when it comes to allowing you access to the property to do your inspection? So as I mentioned earlier, that notice to perform, again, in a different state, it might be called something different. In California, it's a notice to perform. You basically provide them with that document saying, hey, listen, if you don't allow me to do these inspections within, this time frame, then I'm backing out of the contract. Here's the deal. If they don't, then you've got to be willing to back out of the contract and or continue to stay in the process and not get your inspections done, right? It's tough. It's sellers in the state of California are pretty much locked into a contract once they sign it, for the most part, unless the buyer doesn't perform or do something they're supposed to. But as long as the buyer's performing, it's very hard for the seller to back out. In some cases, the seller wants out of the transaction and they're doing things like not allowing inspections, that sort of thing, to get a buyer to back out so that they can actually get out of the transaction. Otherwise, they're pretty much locked in. But if they're not allowing you those inspections and escrow is still moving forward, you've got to make a decision, right? I mean, in California, most people agree to mediate as part of the contract versus getting an attorney and that sort of thing. At some point, if people aren't performing, that's the next step. Is you've got to figure out the solution. You can't just say, "Hey, I'm going to sue you." In most cases, right? There's some sort of process that has to happen before that takes place. But it's two people that need to work with each other in order to get to a common goal. And in this case, you can't close on a property or shouldn't close on a property without doing those inspections. So, it's not necessarily your job. It's more your agent's job of trying to work with the other agent, figure out what's going on, why they're not allowing inspections, and trying to get to the bottom line. So, hopefully your agent can step up and provide that information. And if not, tell you why they're not able to get that information for you. Let's see. Josh,
what do you got?
I think I should save this question to the end, just allow you to rant.
The closer, yeah. I think I saw the winner. Right. Let's absolutely leave that till the end. But there were a couple of quick hitters here that are good ones, easy answers. So Mochi, and I don't think it's Vianney's dog, but Mochi wants to know, if I buy a property from a family member at lower than fair market value, will the property tax be based on the purchase price or the full market value? So again, I'm going to assume you're in California. If you're in California, if it's not a market sale, so you and a family member come to agreement, you don't put it on the MLS, you don't hire Jeb, what they will do, what the county assessor's office is going to do, say this wasn't a market sale, that wasn't made available, so this is not a market price. We need to look and determine what the market value of the home is. That being said, depending on the family relationship that you're buying from a family member, certain types of transfers for someone who's going to move into the property and occupy as their primary residence can be excluded from reassessment. So I don't want to say you can't keep their tax base, but unless it's a parent to child, grandparent to child, most likely you're going to be reassessed at what the fair market value is and have a higher tax rate. So again, that one was pretty easy. Betty Stallworth here follows up, and this kind of relates back to Cedric. So she bought in 2020 and a year later was able to remove PMI. So different lender. Lender said, yeah, we could force you to have it for 2 years, but we're fine. So she asks, though, if prices drop, will the bank reassess PMI on my property? No, they can't. It can't go back and forth and keep coming back to you going, hey, we took it away, we're going to put it back on. Once it's off, it's gone for the life of the loan. And then the last one here, Star Plans says, a coworker mentioned to me, if I'm paying my mortgage, property taxes, and homeowner insurance together in one monthly payment, then I'm paying interest on the property taxes and insurance. File this one under, this is why we don't listen to coworkers and other non-experts when talking about things that are important like real estate. You are actually earning a tiny amount of interest on that. And the reason why I say tiny, on my house, we have impounds, taxes are 550 something bucks a month, insurance another 150, so $700 a month goes in there, and it gets paid out throughout the year. And at the end of the year, I get a nice little statement that says the lender paid me 98 cents worth of interest on the money that they held throughout the time. So it's a very low rate of interest, and there's never all that much money in that account because they're paying out throughout the year. So no, it's actually an interest-bearing account. It's just such a trivial amount that you might as well not consider it interest-bearing, but you are absolutely 100% not paying interest on it. What your coworker may have meant to say is that you're not earning interest by keeping that, but if he has somewhere other than in crypto where you can get a return on that would make it worth the headaches, I don't know where it is.
Johnny Stash, easy answer. No, don't Don't waive all the contingencies. Keep some stuff in place, man. Keep something in place to give yourself an opportunity to back out. It's not good to waive everything. I know some markets, agents are suggesting that. I've sold quite a few properties this year, and none of them have been, waiving all contingencies. So, the most important ones obviously are your loan, your appraisal, and your home inspection. In some cases, you can waive the loan if you're solid client, right? Sometimes Josh says, "Do the client solid, we waive the loan." I look up comps in an area and I say, you know what? I think the value will go here. Let's waive the appraisal. Waive the appraisal. Home inspection is one of those ones that's difficult to waive, especially without seeing another inspection or doing something. So keep something in place just to give yourself an out if you need one. Let's see. What do we got here?
Well, we have the Doom bots have arrived, so it must be towards the end of the show. With no facts or figures, just the world's going to implode here at a moment's notice.
And what's my problem? Why am I so hostile towards buyers?
That was after you answered his question too. That was aggressive.
Yeah. Oh boy.
I think he misunderstood, stating that you need to give a buyer a notice to perform when they're failing to perform, with general hostility towards buyers. Nothing wrong with buyers. There's nothing wrong with sellers. We're all entering into agreements and contracts, and everyone needs to abide by them. These are stressful situations. I just got off the phone this afternoon with a client to congratulate them. They closed yesterday. First-time home buyers, bought at a good price point in a tough market in the Bay Area. And we really just talked about that, how stressful the process was. And they were well qualified. We had them fully pre-approved up front, and their loan went perfectly. And they didn't have a difficult transaction, but just inspections, waiting on an appraisal, releasing contingencies. So that's from the buyer's side. And their seller didn't do anything wrong. But every transaction, when everyone does what they're supposed to in a timely manner, is still stressful. So just don't be a dick. Do what you're supposed to do. Act right towards the other parties. No one's hostile towards buyers or sellers.
No, but understand, when the seller hires me, they're hiring me to get the job done, right? So if you're a seller and you're not performing, I'm probably going to be a dick if you're not doing your job. And I'm not going to be a dick to you. I never talk to you, quite frankly. I talk to your agent, and I'm not being a dick to the agent. I'm just being straightforward to the agent. My communication style is very direct. I'm very pragmatic. There's not a lot of emotion that goes into it. It's very matter of fact. This is what it is. We either move on or we don't. If we don't, it is what it is. And understand, I'm not the one making the decision. The seller's the one making the decision. Just like the buyer's the one choosing not to release the contingencies on the side. The seller is ultimately the one that's deciding on the course of action that we take. I just come from experience saying, hey, listen, if we don't do this, then this is potentially what happens. We potentially get in a situation where they back out a week from now, and now we're asking for a full month of extension on your up leg. And maybe the buyer, maybe the seller doesn't want to do that. Maybe, whatever. So there's a lot of things that go into a transaction, but that's why you need pros on both sides. Let's see here. Did you just say Eli, crypto, bro, and hard assets? What's going on? What are you typing them?
Yeah, he was asking. He's asking why we don't own stocks. Is he crazy?
I do own stocks. I do own stocks.
He's not talking to you, bro. Is your name Lewis?
I don't know, but you commented on from my comment, bro. You came in as Jeb.
I had to explain it to you, and I'll explain to you the way the comments get butchered here in StreamYard once we're done here.
Let's see. Good question from a blast from the past. Who are you? A blast from the past.
I know you.
Do I know you? Are you a skeleton in my closet? If so, please don't come out here. It's not for you. Who should I hire first, a lender or a realtor? So, great question. Either is okay to talk to first, but if you talk to a realtor, typically what's going to happen, if you called me and you didn't have a lender, one of the very first things we do before we talk about where you are in the process, and a lot of that is, hey, you need to talk to my lender, or you need to talk to a lender, have the conversation, see if you're approved, see where you're at in the process, how much are you approved for, all of that good stuff. Because talking to a realtor, you really can't make any progress without knowing the things that lender is going to provide to you. Are you approved? Up to how much? all of that good stuff. Once you have that, then you can come talk to the realtor and say, this is where I'm at. I'm a pre-approved up to X amount, and then we schedule a time to talk about exactly what you're looking for in a home, what areas you're looking, and start that process. So the lender is very, very important in the process. Any realtor that's willing to take you out, showing you property without that pre-approval, being completed is not the realtor that you want to work with. And in fact, some buyers get upset, in wanting you to have that conversation with a lender. Not so much recently, but in my career, I've had, people that don't want to have that conversation. They just want to start the home buying process. And I've seen many deals go south because people aren't taking the time to do it up front. So it is the most important piece of the puzzle, hands down.
And the most stressful. And the most stressful. So that's why I say we can get you 99% done on the front end, so that the stress of the mortgage is done. So you can get to, I used to say the fun part of finding a home, but the fun part of the hand-to-hand combat of getting a contract accepted. And really that's the entire reason. And if you start with me, it's not a problem. And when we're done going through that original pre-approval, the starting pre-approval interview, I'm going to ask, are you working with a real estate professional, or would you like a referral? And probably 50, 60%, no, we have someone, or, oh, we have a family member. Okay, well, cool. Has your family member been in the business long? Well, they got their license a couple weeks ago, and I want to help them get their first commission. At that point, I may try and steer them to a realtor that we work with, or any professional realtor that's done a bunch of transactions. Because what do I want? I want a good outcome for you of you getting a home under contract and a smooth transaction. So just like Jeb wants to refer you to a good lender that's going to close on time with no stress, I want you working with a professional realtor that's going to manage the transaction, successfully get a home under contract, and close it with as little drama as possible. So it really doesn't matter which way you start. It is important that you end up with an expert on both sides of the transaction.
No, absolutely. And before I get to Jennifer's comment here, I did want to put this one up there just because I liked it. Popo Yaya. I don't have any question, but would like to say love you guys. Yeah, thank you. Appreciate you being here. Now Jennifer says, my dad, who purchased his home in 1977, was debating me on the order of it. I'd rather choose my own lender, not be told who to use by my real estate agent. Here's the deal. As your real estate agent should never tell you who to use. I suggest my realtor, that's me. I suggest
use me.
I suggest my mortgage professional, and in most cases that's Josh, because of the relationship, not because we're friends, but because I know the job is going to get done. I can tell you, in however many years we've been doing business together, we've never, knock on wood, you hear it, guys, had a deal go south, not close because the loan went sideways. I know there's full transparency. If something goes wrong, I'm going to know why, and I'm going to know when it went wrong. I'm not going to find out 2 or 3 days later, like the one from yesterday, that the buyer, was no longer working full hours at his job. His time had been cut, and so he no longer made the income, which nobody told me until after the cancellation, right? I'm going to find that up front. And that's why using a lender that I know, like, and trust is someone that I'm going to recommend. But I'm never going to say, if you come to me and say you have a realtor, hey, you can't use that person, you have to use this. In some cases, people ask me for a couple lenders. I'll give you a couple. I know a lot of people in this business, and I know a lot of good lenders, right? But I prefer to use ones that I have more of a history with, just because I know what's going to happen. So no one should ever tell you this is the lender you have to use, or this is the realtor you have to use. You should be given the option to use who you want to use, but suggestions might be made in that process.
Jeb, got an interesting one here. Teresa Farley says, what changes do you foresee in second home markets or vacation markets in the next year?
That's a good question.
The interesting thing that we're seeing in that situation, I'm going to tell you an anecdote from my situation. I think you guys know, I have a vacation home in Rancho Mirage that I own with my in-laws, and we all use it for big chunks of the year, and then we rent it on VRBO. And that pays for it and helped us pay the place off. So it was great. It was a hybrid investment vacation home for us. Well, the city of Rancho Mirage, like lots of cities around California and here in other parts of the country as well, decided they don't like short-term rentals any longer. So as of last month, we're no longer allowed to do short-term rentals. So the good news for us is being able to use it as a short-term rental for the last 10 years, we were able to pay it off. But I look at that and I go, what impact is that going to have on values? How many homes here in Rancho Mirage are vacation homes, and how many are vacation rentals? Because there were people who were saying, well, if I was going to use this myself, I might pay $300,000 for it. But if I can generate $30,000 a year as a vacation rental, I'll pay $400,000 or $450,000 for it. So as more and more of that happens in different areas, I think that will be an issue for some areas where short-term rentals are banned or outlawed. In general, the second home stuff ebbs and flows with the economy. When things are going well, which again, the last 2 years, things have gone very well for people on the upper end of the spectrum, although not as well for people on the low end. So a lot of those higher end people took stimulus money, took stock market gains, and ran out and bought second homes. And I don't think that necessarily is going to change, but I will say a lot of my clients buy a vacation home with the thought they can augment it or supplement their payments or offset their payments with short-term rental income, and that's coming to a stop in a lot of places.
No, and I'll add to that. Josh nailed it on the Airbnb and the short-term rental side. But another thing to factor in is as homes in these second markets continue to appreciate, it's harder to justify some of this stuff, right? I mean, if it's going to cost you X amount to own a property in Palm Springs, for example, if it's going to cost you, $3,500 a month for that second home, but you're only planning on going out there maybe twice a month or whatever, and you can't rent it out, that's going to start affecting the value, right? I mean, if the value of that property were to continue going up, you're just going to have less people that are willing to pay that price because it's less expensive just to go stay in a hotel or go out there and do it, on the short term, find another place to stay or what have you. So I think as those markets continue to appreciate, you're just going to have less buyers willing to pay those prices. I mean, for example, Palm Springs, that whole area, not just Palm Springs, Rancho Mirage, La Quinta, all of that was the prices never moved for the longest time, right? Until probably the last 18 months, 2 years, maybe a bit longer, maybe 3 years, you've really started to see appreciation in that market. For the longest time, you could buy a home out there for the same price you could 3 years earlier. It wasn't really moving. But now that you've started to see the prices go up, I think you're just going to have less buyers going, you know what? I don't know that I'm willing to pay that to have a second home. It wasn't that expensive a couple years ago. Do I really want to pay that amount to have that? And another thing to factor in is another, like I'm using California as a reference because it's where we are, but like Arrowhead, Big Bear, all of these markets, there's literally no property up there. Like people went out and bought everything during the pandemic, and it's going to be interesting. I mean, right at the moment, supply is really tight in those areas. So if something does come on the market, it's moving fairly quickly. But I think if supply does start to increase in those markets, that's the first thing that you're going to see slow down is that second home investment type purchases in those markets, just because, again, that they're not being used. You have that risk or chance of the Airbnb or the short-term rental changing and affecting, the use of that property. So I wasn't aware of that Rancho Mirage thing, Josh. That's interesting.
Yeah, just last month. So you got some crypto money, Jeb.
Got some crypto money. Oh, look at that. $10 from Maddie's property. So Maddie went into escrow. Maddie was having a hard time putting his property in Burbank, I think, into escrow. Finally got in. Things are moving along. So congrats to you. Looking to get a rental in Phoenix. So if you need a good agent out there, I know one.
He doesn't. He's gonna buy 1,000 of those properties from Zillow.
Oh, there we go. 1,000, right? That's great. All right. So we're toward the end here, hour and 52 minutes. If you're watching, hit the like button. I'm going to send Josh on a tangent here. I'm trying to find a question. I'm going to tee him up.
There's actually two of them. Did you see both of them?
I didn't, but we got one's enough to send you on a rant. Let's see if I can find it. Where is it? Where did that thing go?
Here, this was the first one.
All right, let's hear it. Is there any advantage to doing a refi with a commission broker over getting into something like Loan Factory? Okay, that's similar to the one that we're going to tee up here. So, thoughts on using a broker versus an online lender? That's essentially where the other question was.
Yeah, here's the other question. Ant
Yeah.
Ball says, "What's your thoughts on online home mortgage lenders?" So, the funny thing, just earlier this week, Loan Depot announced they're public now, so they announced their third quarter earnings, and they were spectacular, and they attributed it to their sponsorships with Major League Baseball. So for those of you who like baseball, just came off the playoffs, instead of just being bombarded with 9,000 ads a day for Rocket Mortgage, you also get to watch baseball and get bombarded with Loan Depot ads where they imply that there's actual professionals in their call center handling loans for you. What you're going to get in dealing with either of those is an entry-level person who hasn't done loans very long. They get a lot of leads all day when the phone rings from all of those mass market ads. And if they can figure out how to do your loan, which if it's simple enough, they will, what you get in return is very average terms. So you can deal with the McDonald's of mortgages like Rocket or Loan Depot. And I say that with the caveat with Loan Depot that Loan Depot bought a real boots on the ground mortgage company about 5 years ago or merged with them. So Loan Depot actually has real professional loan officers that work out in the field, and then they have cubicle dwellers. And all of those business models carpet bomb mass media with this false impression that they have mortgage professionals instead of kids sitting in a call center. And in return, you get very average terms. So whatever giant call center operation that advertises in mass media that you want to go to, you're more likely to get turned down. You're more likely to get inaccurate information, and you're more likely to get worse terms. So if you really, really feel like it, you guys have probably heard me say this 1,000 times, shop them as one of them. The worst thing you could do would be call them and just get a loan from them. Call them, go to a local loan professional, go to your credit union and compare the three. So we're a broker. And when I say local loan professional, like I was talking about with Loan Depot has real loan officers out in the field that work with realtors like Jeb. Their terms are still going to be a little bit higher than ours, but they're at least going to be a long-term mortgage professional that can advise and guide you. But check 2 to 3 different sources and determine how the experience was. Look at what the terms are. If it's a reputable lender, if you check with 3 different brokers, our terms should be in a fairly narrow range. I will tell anyone, if you check with 10 lenders, I'm going to be cheaper than 9 of them. And that doesn't mean you can't find someone cheaper. I just tell people, I don't go when I'm getting my shoulder replaced next Tuesday. I didn't pick the doctor based off of who was the cheapest. I picked the doctor based off of who was the best. And your health is a little different. I would have picked the most expensive guy if he was the best. On the good side, and the mortgage, you don't have to pick that. You can get a very good professional local expert to you that will get you very good terms. But the only way you're going to know that is checking multiple sources. But please, God, do not buy into this myth that the mass media advertisers are the best source for a loan, because what they pitch their process and service and loan officers as on TV is nothing what they look like in person.
No, absolutely. And got a super chat. Jennifer came in, which is our moderator, and gave a $25 super chat. So thank you, Jennifer. I appreciate that. It's not necessary, but it is appreciated. So thank you that. So there's some questions here on buying and should you buy? Is now the right time to buy? All of that stuff. And to keep this short, here's the deal. I don't think the market's going anywhere. We're going to kind of sum this up at the end. Don't think the market's going down in value. I think if anything, you see stabilization in the market, but I don't even think you see that. I think 2022 probably brings another, I would say 5 to 7% appreciation. There's a lot of people out there saying more than that. 5 to 7, I think, is reasonable. I think it's fair. Should you go out and buy a house because I said that? Absolutely not. It has to be the right time in your life. As Josh said, you need money in the bank to pay Josh's lights because they just keep going out. Now, you need money in the bank outside of your down payment. If you lose your job, you need to have some money on the side. You need a longer term time horizon, 5-7 years, like I said. And it needs to be the right move for you, right? Not because somebody else is buying a house, not because you think the market is going to appreciate again and you want to get that equity and move it into something else or whatever. It needs to be for the right reason. So if you're doing that, it's always a great time to buy real estate. that's my 2 cents. Josh, how do you want to exit
I
today,
would
my friend?
I would look at it this way. If you asked that question in 2010, I have told this story here before. I was screaming from the mountaintops to anyone who thought they might have an interest in owning a home, buy them. It's cheaper than renting and they have nowhere to go but up. Not that they were going to skyrocket, but had nowhere to go but up. Had people that wanted to buy a first-time home, you could get them for $300,000. It was less than renting an apartment. No one wanted to listen. And at that point, I would say that is a raging green flag. Jump into the market. Right now, where we're at, there's elevated risk because home values are double what they were 10 years ago. So you want to look at it. You want to make sure it is the right time and point in your life for you to buy, that you have a longer term time horizon, and that you're doing this with your eyes wide open. In 2010, you could have been not paying attention, picked whatever random property, and time would have taken care of you. It is important that you do your homework and pay attention. But as Jeb said, we have more room to run on the upside, probably another 20, 25% increase in home prices. So if you think that you want to wait it out, it's going to be a long time and the prices are going to be higher. And if we do get that 10% correction that we were talking about versus long-term plateau, a 10% correction from 20% higher prices didn't really help you. Plus, you didn't have the mortgage principal reduction pay down that you would have over that time. So for anyone who seriously thinks this is the right time in their life to own a home, I wouldn't hesitate to buy. I would be very serious and deliberative about it and make sure I'm making a good decision.
Nailed it. So, yeah, thank you, Josh, as always, for being here. Appreciate everybody that continued to watch. Again, we've been here for 2 hours, so thank you for that. If you haven't done so already, hit that like button. Share it with anybody you know looking to buy. We're here every Wednesday. In fact, Josh isn't going to be here next Wednesday, so I'm going to reach out. I'm going to try to find a fabulous guest for you guys to come on next week to replace Josh, and he'll be getting surgery, so you guys can say a little prayer for him. I hope he gets better. Shoulder.
I might zoom in from my hospital bed. How about that? For like
that'd be hilarious.
Like a 2-minute cameo, and then I say incoherent shit. You can cut me off.
That's perfect. I just want to do that anyway. Anyway, thank you guys for being here. Subscribe to the channel if you haven't already. Adios, my friends.
See ya.
Until next time.